Hi, folks. John Duncan. Today we're going to talk about something that many people aren't aware of. And I titled this, It's the Money, Not the Market. How the banks and government are debasing modern money and how the informed are getting richer than ever because of this fact. Now, first, we're going to talk about something. This is from the Federal Reserve Bank of St. Louis, and this shows the total amount of bank vault cash. This is cash that doesn't have any debt attached to it whatsoever. There's $76.484 billion as of July 24, 2019. Now, using something we're going to discuss shortly, which is called fractional banking, banks have parlayed this, what we call real money, $76 billion, into almost $13 trillion in deposits. So they have multiplied vault cash, or you could read real money, via fractional banking 167 times. Meaning for every real dollar, through loans and fractional banking, they have multiplied that on their bank books 167 times. So $167 where debt is attached or an interest is due on the money to every dollar that's free and clear. This is what I like to call the mother of all trends. Mother of all trends, the money supply growth. As you can see, back in the 60s, it was pretty flat. Ever since then, we've had a couple even outs, but all in all, straight up. And as you can see, the process is escalating. In the stock market, they call it the trend is your friend. This is the mother of all trends. This year, 2019, this is from the Federal Reserve and U.S. Treasury. Of all the money created this year so far, $949 of debt money has been created for every real dollar that has no debt. And that's in calculation of $655 billion that have been added to the currency, to the money supply. Just yesterday, August 19th, President Trump went on Twitter to yell at the Fed chair, Jerome Powell, to drop our super low interest rates by even another 1%, which is getting them further down to zero, and also to restart quantitative easing, which is basically what quantitative easing is where the banks aren't loaning money fast enough, the government will come in and inject money into the system on top of the money that's already being blown up in the system through banks. You can see here, this is debt. You can see in the 60s, it was relatively flat. 1971, we went off the gold exchange, and it is going up like a rocket. You can see this is when the meltdown happened after the housing crash and all that. And just that little blip where they stopped the money presses on the lending side almost collapsed the entire system. But you can see they got that fixed, and boom, the trend continues. The trend continues going straight up like a rocket. You can see government bonds. This has been in the news a lot lately. U.S., this is 10-year bonds. This is 10-year rates right here. You can see Germany, Japan, France, all in negative territory. And these have actually dropped. This was a couple of weeks ago. They've even dropped from here, actually almost a month ago. They've dropped from here. Why? Money itself is nothing but the fuel to accelerate assets such as homes, businesses, technology development, all those type of things are fueled by cash. Well, now cash has gotten cheaper than ever. Now, a lot of people think they understand reserve requirements on a bank. I'm going to bring it to you right here. This is the requirements as of January this year. You can see if you're a small bank, between 0 and 16.3 million, you don't even have to have reserves at all. I was pretty shocked when I was doing the research on this. You don't even have to have any reserves. Somebody puts money in, you can loan it all right back out. If it's a mid-sized bank, you have to have a reserve of 3%. Over 124, like the Bank of America's, Chase, all those, you have to have a 10% reserve requirement. 10% reserve requirement. But here's what's interesting. A lot of my clients own businesses, and for whatever reason, a lot of cash flow coming in and out. Non-personal, like business accounts, there's 0 reserves as well. And then euro currency, 0. As you can see from this slide right here, $100 going in the bank with a cumulative 10% reserve rate. This is deposit 1, 2, 3 on down, individual deposits. You can see that $100 creates almost $1,000 of new money or lendable money out of thin air. So we're going to use the money multiplier here. And you can see that basically to find out how much money can be created on a deposit, here we are. It's 1 over the reserve requirement. Well, if you were at Chase Bank even, and it's a personal deposit, you're talking 100 million, just say it's 100 million in a bank, 10% reserve actually creates 1 billion that can be actually loaned out. And another way to think of it is $900 million can be created out of thin air. This is how the currency itself is being debased. 3 false money assumptions that everyone makes. Assume no need to become money smart. Average investor comes in. They want to talk about investments immediately instead of getting smart about the money itself. Billionaires are smarter about money than they are about investments. They're smart about getting loans from a bank at a certain rate. Say you got a loan at 4%, and you had a house or insurance or anything, some pay 6%, something safe, something secure, 6%. Do you realize just the difference between the two? You could actually make 50% return on your money in a 6% investment. That's being money smart, and it's keeping you ahead of the game, because the game right now is the trend is more and more currency, which means less and less value of the actual money. Number 2, we had just assume money maintains value. And as you can see, because they're printing it into oblivion, that value is eroding or evaporating. The third, and this is the cause of all the confusion for most people, they assume debt isn't money. You see, if a person gives a person a loan, the first person doesn't have that asset while the other person has it. Then it's paid back. Now the second person doesn't have it because it gave it to the first. Banks work completely different. Mary can go put $100,000 in Bank of America. Joe can come in right behind her and request a loan. Well, because of the reserve requirement, they can loan out $90,000. Got to keep 10% back in case Mary wants her money back. But on the bank's books, if Joe deposits the $90,000 loan, He could be at the same bank. He deposits a loan, even though it came from Mary, the money to do it. The bank now shows $190,000 on deposit, not the 100 that was the original money. Now that can continue on and on and on, hence the money multiplier. In other words, if Joe took the 90,000 and deposited it back into Bank of America or into another bank, now they have to keep 10% of that, so now they can loan 81,000 to someone else, and it just goes on and on and on down the line. So bottom line is that money, they are essentially, because of the way fractional banking works, they are printing money out of thin air. Why am I saying all this? Because schools do not teach this. The financial industry does not teach about the actual thing that we're investing, which is the money, the thing we work for, which is the money. And the smarter you get about the money, then the rest of it all becomes pretty simple. What do I mean? The 3 pillars of wealth: tax control, leverage, passive assets. All 3 become much easier to grasp and implement once you understand what's going on with the money. So with that said, my name is John Duncan. I hope you learned something good from this presentation. Thank you.